Hi, everyone. Thanks for joining us on another episode of Building Your Wealth Bridge. Today, Zach and I wanted to recap the first half year in the markets. It's about the midway point. We're filming this on July 9th. Talk about investment performance. There's been plenty of news driving markets the first half of this year, and then look at some things that we're going to expect in the second half of the year. So, got a chart here on your screen if you're watching. Showing the major indexes with the S&P 500, the MSCI EFA, which is the International Developed Market Index, the Emerging Markets Index, and the U.S. Aggregate Bond Index, which is the green line. And for the first time in what feels like a long time, we're seeing the international index, both EFA and emerging markets, outperforming the S&P. And I think there's a number of reasons for that, but it highlights the importance of being diversified, especially in a year where you're getting 20% out of, Europe, Japan, countries like that. And the U.S., is at a new all-time high, but suffered a 20% drawdown earlier this year. And it's kind of been a tale of two quarters the first half of this year.
Yeah, I think it's funny too. Like if you look at this chart, some people check their portfolios on a daily basis. Some, maybe just get their quarterly statements and that's all they see. And they see, U.S. stocks outperformed bonds and, international outperformed all that. And, kind of people overlook, what happened in April. And they see that the bonds returned 4%, the lowest of anything there, and think of, why did I hold bonds and, didn't make as much money as everything else. But, bonds really held in good during that volatility that Will was talking about in April, where the max drawdown for bonds was, about 1%, where, like Will said, the U.S. stock market was down about 20%. The international markets were down, 12 to 13%. So being diversified and holding some bonds, really, lessened the drawdown during that period.
Yeah, the preservation aspect of bonds is one of the best pieces, but now where we are today, you're also getting a good yield. So looking at the ag, which is, think of the S&P 500 of bonds, just the investment grade bond index, it has a yield around 5%. So your coupons in a year, what you're receiving in interest payments is around 5%, has a duration of around 6. So your average bond maturity is 6 years. So just doing some simple math, you can expect a 5% compound annual return over the next 6 years. That's, nothing to scoff at, not as attractive as what the U.S. stock market has done over the last 5 years, but there's no guarantee that the stock market will continue to do as well. So diversification is a good strategy, preserves your portfolio, provides some nice income, and then also gives you the opportunity to rebalance when stocks do go down. And, some of our clients got to take advantage of that in the first quarter when there was a very sharp, rapid sell-off, about 20%, and bonds were up. At that point, you can, buy the dip in those situations.
Another thing kind of building on this, I think we want to talk about, we said international was outperforming, but in this next chart, we could see kind of country by country. In terms of the EFA versus the emerging markets index. So like Will said, EFA stands for Europe, Asia, and Far East, whereas emerging markets is more your countries like, China, Taiwan, Brazil, kind of more up and coming, and I have Poland as well as part of that. But you can see over the last year, Greece has been the best performing country, followed by Israel, which is surprising considering everything that's gone on in Israel over the last year. Like I said, Poland is up about 59% so far this year. Over the last 1 year, about we'll say 30%. But a lot of the companies that make up these indexes are companies that people you would recognize, things like Nestle or Novo Nordisk or AstraZeneca or Shell, or ASML is a big think it is Norwegian technology company. So there's great companies all around the world, and we want to make sure we own pieces of them all.
Yeah, prior to this year, I think the big story about investing internationally was the low valuations. Um, and that's still the case. Valuations are cheap compared to the US, but there's some pretty major macro themes that are developing around the world of why you want to be invested internationally. Germany announced a large stimulus program. If you remember back in the first quarter, Chinese AI giant DeepSeek totally disrupted US tech, and Chinese large tech is actually outperforming US tech this year. And their EVs are also with a company like BYD outperforming Tesla, especially with the tax bill, kind of discouraging some of the renewable and cleaner energy investments here in the U.S. It's not, companies aren't as incentivized to do that anymore. And then another factor that's kind of driven the international outperformances would be the dollar depreciated. I think the dollar is down 10% relative to a basket of outside U.S. currencies, and a falling dollar, means an appreciating foreign currency, and that helps U.S. investors in international stocks. So it's a good way to hedge against the weaker dollar.
Yeah, absolutely. I think that's a great point. And you can see the U.S. on this chart as well, kind of just to the right of the green global bar. And I don't think any of us would say, we don't want to invest in the U.S. I'd say that the majority of portfolios are based in U.S. investments. And I heard something today that was really interesting, saying the U.S. innovates, China imitates, and the UK or Europe regulates. And there's, I thought it was kind of funny, but I do think we think the U.S. has some of the most innovative companies in the world, and we want to make sure we remained invested in them. And some people see, the U.S. sold off a good amount in April and recovered back to an all-time high. And I thought this chart was really interesting, just showing the number of all-time highs hit every year in the S&P 500 going back to 1929. So you can see the bottom right there in 2025 so far, we've hit 5 all-time highs. So some people see that and say, oh, I don't want to put new money to work in the U.S. Let's invest elsewhere, or wait for a sell-off. But all-time highs tend to kind of cluster together. Just last year there was 57 new all-time highs hitting the S&P 500, and if you look at from 2013 to 2022, I don't know, what did we average? 30 new all-time highs each one of these years. So they kind of tend to come together. And one other kind of chart here that we wanted to show is just showing the returns associated with investing at all-time highs. So the dark blue column shows your 1 year, your 3 year, and your 5 year returns if you invest on the day of those all-time highs, which in your head you think, oh, if I'm buying things at the highest price, you probably don't do as well. But that's not the case. The gray bar shows if you invest on just any other day in the S&P 500, and your returns end up being slightly better if you buy on the all-time highs, which I was kind of surprised to see. So we want to remain globally diversified, and make sure that we're probably, if you have the ability to dollar cost average, and just always be buying into the U.S. and international stocks. I think that we think that's one of the best ways to invest money.
Yeah, absolutely. And just thinking about some of the biggest events in the U.S. that, I mean, obviously the tariffs, which we covered in our last call, which is still an ongoing situation, but we just had a recent tax bill that could really impact markets, and I think we'll probably have a separate call on some of the individual investor, like you and I and our clients, implications and changes in the tax law. But from a business perspective, some things that could be exciting for investing in the U.S. market. Companies can expense investments in new equipment and R&D, which can really lower their taxable income, along with this 100% depreciation write-offs for new facilities. So these are big deals. I think companies that were, maybe on the fence about building out some manufacturing here, now there's a real hard dollar figure that they can assign to new projects. So, the U.S. economy is in a good place. I think the Atlanta Fed does a GDP now calculation trying to anticipate this quarter's GDP growth, and is at like 2.6% this quarter at the most recent reading. And the economy, I think, declined like 0.5% in the first quarter, and the market was down. A lot of that, front running the tariffs was a big story, like companies building up inventory, trying to get ahead of, potential higher costs. But going forward, this tax bill, should really, I think, be a positive for markets. And we'll see. But Zach, did you have any thoughts on like the next 6 months, going into the end of the year?
Yeah, no, I think that's a really good point. I think, around the Liberation Day and all the tariff talk that was happening in April, I think a lot of companies were kind of in a wait and see what happens with tariffs before spending on different new equipment or building a new facility or really any sort of capex. And now that tariffs we're kind of getting some more clarity over what those will be. Granted that could change by the day, and with the stuff that you had mentioned in this new bill, maybe we'll see some more companies spending money, which will ultimately lead to hopefully higher margins and revenues for companies. Because at the end of the day, we talk about these different indexes, the S&P 500, but those are made up of companies that are out there working to increase their revenues and make more money. So I think there's a lot of potential tailwinds, things that could be good for the market for the rest of the year. But we'll kind of just take it 1 week, 1 month at a time. And there's something that could happen tomorrow that really could change the narrative of the rest of the year.
Yeah. I think one other thing I'll add to that is, and something we didn't cover on the small cap index. It's kind of often overlooked, hasn't been one of the strongest performers in the most recent years compared to the S&P and the large caps. But, looking at year end, I think the market's anticipating 2 rate cuts. And, from what we're viewing, it doesn't look like there's an imminent recession anytime soon. The economy seems to be in a pretty healthy place. A no recession rate cut environment, I think could be a huge tailwind for small caps. And talk about like lower valuations internationally. Same thing with small caps. Like they're very inexpensive compared to some of the large cap like technology companies.
Yeah, I think that's something we're all excited about here at McKay for the rest of the year.
That's right.
I think that's kind of about everything that we have for you today. Is that right, Will? Anything else?
No, I think that'll be. I'll just keep talking about it. But
all right,
no, that's it.
Good. Thank you all for your time. And if you have any questions about what we cover here today, or anything about it in the markets at all, please contact your advisor. And have a good rest of your summer. And we will be back to you soon with another episode.